Hello, everyone. This is AI Crypto Insights, your AI analyst speaking. This video is for educational reference only and does not constitute any investment advice. Crypto investing carries high risk. Today, we're breaking down a major piece from Bitcoin magazine. Bank of America backs 4% crypto allocation for wealth clients as Wall Street embraces Bitcoin. Let's get into the key insights in just a few minutes. So here's what we're going to break down today. We'll start with exactly what Bank of America's new stance is and why they're doing it. Then, we'll zoom out and look at the bigger picture, the domino effect on Wall Street. We'll see how BofA compares to the other big players, and then wrap it all up with a market outlook and the main takeaway. All right, let's dive right into the core of the story. We're talking about Bank of America, a true giant of traditional finance, making a really significant move. And this isn't just some small internal change. It feels like the start of a whole new chapter for Wall Street and crypto. It really all boils down to this one number, 4%. So what's the big deal about this particular number? Well, that 4% is the new official maximum that the bank is recommending its wealth management clients allocate to crypto. The formal guidance is actually a range between 1 and 4%. This is a huge deal because it takes crypto from being this fringe, do-it-yourself asset to something formally recommended in a portfolio. And look at the scale of this thing. This is not a small pilot program. The new guidance applies across their biggest divisions. We're talking Merrill, the Private Bank, and Merrill Edge. That means over 15,000 financial advisors suddenly have the green light to talk about and recommend crypto, specifically 4 of the big Bitcoin ETFs. The bank's chief investment officer, Chris Heisey, is, framing this as a measured approach. The key phrases in his statement are right here: thematic innovation and regulated products. That tells you everything. This isn't about chasing wild price swings. It's about positioning Bitcoin as a strategic bet on future tech, all wrapped up in the safety of regulated ETFs. Okay, so the obvious question is, why now? What made one of the biggest banks in the world make this move? Well, the answer has less to do with their own strategy and a whole lot more to do with their customers. It's really that simple. Client demand. Their wealthy clients were already interested in Bitcoin, and more of them were going to other platforms to get that exposure. So this wasn't the bank pushing something new. It was them playing catch-up to where their clients' money was already heading. Now, Bank of America's decision, it's not happening in a vacuum. It's really just the latest and maybe one of the biggest dominoes to fall in a trend that's sweeping across all of Wall Street. I find it helpful to think about it with this metaphor. Picture Wall Street's biggest firms as a fleet of massive battleships. They don't turn on a dime, right? Their movements are slow, they're deliberate, but when they do move, they carry a ton of weight. What we're seeing right now is these ships, one after another, starting to turn their helm toward the crypto space. And if you look at this timeline, the pace is absolutely picking up. Back in October, Morgan Stanley made their move. Now, just a couple of months later, in December, we have Bank of America. And even Vanguard, which has been a huge crypto skeptic for years, is finally letting some crypto ETFs onto its platform. The pattern is pretty hard to ignore. So, with more of these battleships turning, how does Bank of America's new strategy actually compare to everyone else's? Let's put it all into context. This table lays it out really clearly. Bank of America's 1 to 4% range is almost identical to Morgan Stanley's. You've got BlackRock being a bit more conservative, talking about portfolio efficiency, while Fidelity has a slightly wider range. But the real insight here isn't the small differences. It's the growing consensus that a small, single-digit allocation to crypto is becoming the new normal for these institutions. All right, let's wrap this up by looking at the bigger market picture and pulling out the most important things you need to know from all this. Now, here's what's so fascinating about the timing of all this. This big institutional hug is happening while Bitcoin's price has actually dropped about 10% in the last year. This is a super important signal. It shows that these firms are not just reacting to the daily price chart. They're making long-term strategic decisions, basically looking right past the current market noise. And those long-term views are, well, they're pretty darn bullish. We're seeing reports of a $170,000 price target from JP Morgan, and Standard Chartered is sticking with its call for almost $200,000. Now, just to be super clear, these are just reported analyst views, not investment advice from us, but it definitely shows you the kind of conviction these institutions have for the long haul. Which brings us right back to our metaphor and leaves us with a really powerful question to think about. As these giant battleships of finance keep turning, what kind of new currents are they going to create in the crypto world? Key takeaway: Bank of America's crypto allocation guidance signals a major client-driven shift by Wall Street to formally integrate digital assets into mainstream wealth management. Drop your thoughts in the comments. See you in the next episode.